Welcome to The Explainer. Today we're diving headfirst into the massive, constantly moving puzzle of international markets. And we're going to look at it through the lens of one of the most dynamic, fast-growing economies on the planet right now, India. We're going to see exactly how this global engine of trade works, and honestly, how it has completely rewired the Indian economy over the last few decades. Let's get right into it.
Here is our roadmap for today. First, the engine of growth. Second, India's trade transformation. Third, recent trends in trade. And finally, keeping the score.
Starting with part one, the engine of growth. Let's cover the absolute basics.
No country in the modern world is completely self-sufficient. Every single nation has its own unique mix of stuff. Natural resources, skilled manpower, different technological capabilities. And because no one has everything they need, goods and services are in this constant, endless flow across international borders. That flow, that is foreign trade. And it basically comes in three distinct flavors.
Flavor number one is import trade. This one's super straightforward. It's just an inflow, where one country purchases goods and services from another. Take India, for example. To fuel its absolutely booming economy, India imports a massive amount of petroleum from countries like Iraq, Kuwait, and Saudi Arabia. They need that fuel, so they buy it and bring it in.
Then we have the exact flip side, export trade. This is the sale of goods by one country to another. Historically speaking, India has been a major exporter of agricultural and primary goods. We're talking about items like tea, rice, and jute. They sell these to nations like China and Singapore, really capitalizing on their abundant natural resources.
Now, the third type is a little trickier, but it is absolutely vital to the modern global supply chain. It's called entrepot trade. Think of it as being the ultimate middleman. A country purchases goods from one nation, brings them in for some processing or manufacturing, and then boom, turns around and sells the finished product to a third country. Japan is the textbook example here. They'll import raw materials from places like England or Germany, use their highly skilled workforce to build complex electronics like TVs and washing machines, and then export the whole shebang out to the rest of the world. Pretty smart, right?
So why exactly do economists call this the engine of growth? Well, it's not just about earning foreign exchange, though obviously that's huge. It completely opens up the playing field. It encourages massive investment because suddenly producers have the entire globe as their market. It stabilizes domestic prices, and it optimizes resource allocation so countries can just focus on what they're actually best at doing. Plus, for consumers like us, it means we get multiple choices and way better quality. And over time, it builds serious international goodwill. Just think of Germany's worldwide reputation for precision engineering. That is trade at work. All right, moving into part two, India's trade transformation. Let's look at some big historical shifts. The evolution of India's trade is a really fascinating story of contrast. If you go back to before independence, India was set up as a classic colonized economy. They were basically just shipping out raw materials like raw cotton and tea and importing finished consumer goods. But man, over the last 70 years, they've completely flipped the script. Fast forward to today, and India's prime exports feature manufactured items, gems, and incredibly complex computer software. Meanwhile, they're importing high-tech machinery to continue building up their own industrial base. It's a total 180. And the sheer scale of this economic integration, it's staggering. Look at this number, 48.8. That number represents India's foreign trade share as the percentage of its gross national income during the 2016 to 2017 period. To really put that into perspective for you, back in the early 1990s, that number was just 17.55%. In a couple of decades, trade went from being a supplementary part of the Indian economy to an absolute cornerstone, making up nearly half of their entire gross national income. That is wild.
Which brings us to part three, recent trends in trade. Let's dig into the modern data.
So historically, Britain was India's undisputed primary trading partner. But look at the map today. It looks vastly different. A staggering 44% of India's exports now go to other developing nations. That's followed closely by highly developed OECD economies at almost 38%. The US has actually emerged as a top trading partner right alongside heavyweights like Germany and Japan. What this means is that India has built this incredibly diverse, resilient portfolio that can better withstand any localized economic downturns. And when we peek inside those outbound cargo ships to see what exactly is being packed, one category is totally stealing the show: engineering goods. According to recent data, this sector now accounts for a whopping 25% of India's total exports. A quarter. And we aren't talking about simple stuff here. We're talking automobiles, auto components, heavy machinery, and specialized transport equipment. The crucial point here is that India is no longer just selling raw materials. They are rapidly becoming a major hub for high-value, sophisticated manufacturing. Now, the petroleum story, this is a textbook example of a maturing economy. See, for a long time, India was purely an importer of crude oil. They just bought it and burned it. And sure, they still import tremendous amounts today. But in the early 2000s, there was this massive surge in domestic refinery capacity, and it completely changed the game. Now the model is import the raw crude, refine it domestically, and then, here's the kicker, sell that refined petroleum back out to the global market. Incredibly, that now makes up about a fifth of their total exports. Talk about a glow-up. Flipping over to the import side, petroleum remains the undisputed heavyweight champion, accounting for around 31% of total imports. But here's a really fascinating quirk in the data. Gold. Historically, gold was the second most imported item, thanks to a massive, deep-rooted cultural demand. But around 2013, those imports saw an astonishing nosedive. A combination of falling global prices and very strict government policies deliberately slashed gold imports by nearly half, just to protect the country's trade balance. At the same time, we're seeing imports of things like fertilizers and iron and steel steadily declining, mostly because domestic production is ramping up to meet that demand. All right, let's wrap things up with part 4, keeping the score.
With literally trillions of dollars flying across borders every year, you might be wondering, how on earth do economists keep track of who is winning or losing? Well, they use two specific concepts that honestly get confused all the time: balance of trade and balance of payments. Let's clear it up. Think of the balance of trade, or BOT, as the receipt for physical goods. It is strictly the difference between a country's visible exports and visible imports, physical items you can touch and put on a ship. Balance of payments, or BOP, on the other hand, is the master ledger. It's the big one. It is a comprehensive, systematic record of absolutely all international economic transactions. So visible goods, invisible services, capital transfers, everything, between the residents of one country and the rest of the world over an entire year. To really nail down the outcome of that physical trade we just talked about, the famous economist Paul Samuelson summed it up beautifully. He said, and I quote, "If export value is greater than the import value, it is called as trade surplus. And if import value is greater than export value, then it is called as trade deficit." Basically, if you sell more physical goods to the world than you buy from it, your export value is greater, and you've got a trade surplus. You are accumulating capital. But if you buy more physical goods than you sell, you are sitting in a trade deficit. So, taking a step back, we've seen India's incredible evolution. From exporting raw cotton under British rule to exporting complex engineering goods, refined petroleum, and software to a highly diverse set of global partners. The structural shifts in its trade DNA are absolutely undeniable. So the question I want to leave you with today is this. As India keeps heavily investing in its manufacturing and tech infrastructure, how is its master ledger going to shift in the coming decade? Are we going to see a complete reversal of its historical trade deficits as it fully transitions into a high-tech export powerhouse? Honestly, it's a fascinating trend to watch. And hey, now you've got the analytical tools to track it yourself. Thanks so much for joining me on this explainer, and keep